The financial media told you silver had peaked. They told you the rally was over. They said the same thing in 1979, 3 months before silver went up another 400%. I want to show you exactly why the people calling silver dead in this market are making the same mistake that has bankrupted the bears in every single precious metals cycle in modern history. There's a peculiar kind of wisdom that comes not from reading about markets, but from living through them, through the slow grind of cycles that most investors never survive with their conviction intact. 25 years of watching gold and silver behave, misbehave, collapse, and resurrect will teach a person something that no financial textbook adequately conveys, that markets do not repeat themselves with mechanical precision, but they do, as the old saying goes, rhyme with a rhythm that the patient observer can hear and the impatient speculator invariably misses. This is precisely the moment in the great precious metals narrative where that rhythm is beginning again, and the music, if you know how to listen, is unmistakable. Let us begin where all serious analysis must begin, with history. In the entire recorded span of gold's modern trading existence, there have been only 3 genuine major breakouts. 3. Not 10, not 25, not the parade of false dawns that fill the financial press with breathless headlines. 3 structural generational breakouts, each followed by a significant post-breakout correction, each correction followed by a rally that made the correction seem, in retrospect, like the single greatest buying opportunity of its era. We are, right now, living through the correction that follows the third, and the analog analysis, comparing the current correction against those of 1973 and 2006 on a proportional scale, reveals something that should stop every serious investor cold. This correction has tracked the 1971 to 1973 template with a fidelity so precise, it borders on the uncanny. But here is what no one is telling you, and this is the part that should make you sit forward in your seat. Because if you leave this video before the next 60 seconds, you will miss the single most important sentence in this entire discussion. The question is not whether gold is going to rebound. The data is overwhelming that it will. The only question, the one that separates the investors who capture transformational returns from those who are merely along for the ride, is whether the bottom has already been established or whether one final, sharp, sentiment-crushing low awaits before the multi-month rally begins in earnest. This is not a trivial distinction. Understanding it is the difference between buying at the ideal moment and watching your position go briefly underwater before the tide turns. Consider the 2 scenarios with the clarity they deserve. In the first scenario, which the 3 consecutive weekly bullish hammer candles on the gold chart appear to support, the bottom is already in. The fledgling rebound we are seeing right now is the genuine beginning of a multi-month rally that carries gold toward the significant resistance level at $4,400 per ounce. The weekly candle structure, for those who understand technical analysis, is about as constructive a signal as the market is capable of producing. 3 hammers in succession is not noise. It is a statement. The market, in its collective and unconscious wisdom, is refusing to close lower, and that refusal has meaning. The 2006 correction analog suggests this scenario, a steady, methodical recovery rather than a dramatic vertical reversal. In the second scenario, this early rebound stalls. It loses conviction somewhere around current levels, rolls over with whatever macroeconomic catalyst the moment provides, perhaps a Federal Reserve policy surprise, perhaps an inflation report that rearranges rate expectations. And gold makes one final, lower low, somewhere in the neighborhood of $3,700 to $3,800 per ounce, which corresponds with extraordinary precision to the 50% Fibonacci retracement of the prior advance. And here is what is fascinating about that second scenario. If it occurs, it would actually set up an even more powerful and decisive rally than the first scenario. Markets that produce a false breakdown, a final capitulation low that briefly pierces support before reversing violently, have a historical tendency to move further and faster in recovery than markets that simply stop falling and turn higher. The deeper the final flush, the more explosive the rebound. History is unambiguous on this point. Silver, characteristically, tells the same story with considerably more drama and considerably more volatility. The $70 level represents the equivalent of gold's 4,400, a zone of significant technical resistance that any meaningful rebound must eventually confront. The path to that level may not be straight, and the intermediate turbulence may test even the most resolute holder of precious metal positions. But the destination, on the weight of the evidence, appears to be a matter of when rather than whether. Now, what transforms these technical observations from mere chart reading into something approaching genuine conviction is the sentiment data. There exists a proprietary indicator tracked by the research firm Sentiment Trader, specifically the 50-day moving average of their optics indicator for the GLD Exchange Traded Fund. That has an almost eerie track record of identifying significant sentiment lows in precious metals. This indicator registered comparable readings at or just before the significant lows of 2008, 2016, 2018, and 2022. Every single one of those lows was followed by a substantial rally in gold and related assets. The current reading is in that same neighborhood. That is not coincidence. That is the market's internal psychology reaching a state of exhaustion that historically precedes recovery. There is one more thing you need to understand before we go further. And it is the thing that most YouTube channels, most financial newsletters, and most market commentators will never tell you plainly, because plain truth is commercially uncomfortable. So if you are finding this analysis valuable, if this is the kind of rigorous, historically grounded work that you have been searching for, please subscribe right now. Hit that button. Because what comes next, in part 2 of this analysis, is the macro picture that explains not just where gold is going in the next few months, but where it is going over the next 2 to 3 years. And the number, the destination, is going to surprise you. Stay right here. If you think this correction in gold is telling you to walk away, you need to hear this next part immediately, because the correction is not a warning, it is an invitation. And the investors who recognize the difference between the two are about to be separated permanently and dramatically from those who do not. What I am about to show you has only set up like this twice in the last 60 years of financial history. Both times, the investors who acted decisively became wealthy beyond what they had dared to project. We are at that crossroads again, right now. The most important analytical tool for understanding where precious metals stand in the grand arc of their bull market is not a price chart. It is the ratio of gold to the S&P 500. The measure, in other words, of how much capital the world's investors have shifted out of equities and into the ancient alternative. And when you examine this ratio over the last half century with the detachment of a historian rather than the anxiety of a day trader, a pattern emerges that is as clarifying as it is alarming. The great secular bull markets in gold, the one that ran from 1971 to 1974, the one that resumed from 1976 to 1980, and the one that unfolded from 2001 to 2011, all shared a defining structural characteristic. In each case, the gold-to-S&P ratio surged for an extended period, often for 4 years or more, as massive quantities of capital rotated out of equities and into precious metals. The 1971 to 1974 move produced an 8-fold increase in gold relative to the stock market over roughly 4 years. The 1976 to 1980 move was even sharper in its trajectory. The 2001 to 2011 move was more gradual, but ultimately equally decisive. In every case, what powered the multi-year advance in gold was not merely inflation fear or geopolitical anxiety, though both were present, but a genuine structural rotation of enormous pools of capital from one asset class to another. Now examine the current environment with honest eyes. The capital rotation into gold over the past 2 years, whereas while real, while producing genuinely impressive returns, and while establishing new all-time high prices, has been nothing on the scale of those prior secular moves. The gold-to-S&P ratio has moved, but it has moved modestly. 2 years of capital rotation, producing a roughly 200% increase in gold, is historically a beginning, not a conclusion. Compare it to the 8-fold gold-to-equity move of 1971 to 1974, and the distinction becomes almost comical in its clarity. We are, on this metric, in the early innings of what historically has been a 9-inning game. But there is more. And this is where the analysis becomes both more exciting and, for those with the intellectual courage to follow it to its conclusion, more demanding of attention. The 3 great secular declines in gold, the collapses of 1975 to 76, the crash of the early 1980s, and the long deflation from 2011 to 2018, all followed a distinctive architectural pattern. Prior to each decline, gold had spent years, sometimes a decade, outperforming the stock market with a persistence and magnitude that generated the kind of speculative excess that eventually becomes self-correcting. In each case, there was a recognizable topping structure, a period of distribution, of erratic price behavior, of sentiment moving from greed to something approaching religious fervor, followed by a structural breakdown. The current correction in gold has none of those characteristics. There is no extended topping structure. There is no evidence of the multi-year epic capital rotation that preceded the prior secular collapses. The correction we are experiencing right now has lasted 5 to 7 months and has produced a price decline of roughly 22 to 30% from the highs, which places it in exactly the same historical territory as every other significant post-breakout correction in gold's modern history. Those prior corrections, without exception, were followed by resumptions of the primary bull market trend. The current correction, on every available historical metric, belongs in that category. This is precisely why the 1975 to 1976 analog, the dreaded scenario where gold collapsed 50% before eventually recovering, does not apply to the current environment. Before that collapse, gold against the S&P had moved 8-fold in 4 years. The speculative excess was extraordinary. The setup for a major reversal was firmly in place. None of those preconditions exist today. The absence of the cause makes the repetition of the effect vanishingly unlikely. What is far more likely, and this is the forward projection that deserves your careful attention, is something that looks like 2001 to 2003, or like 1972 to 1974. In those periods, the S&P 500 entered what became, in retrospect, a significant bear market. The stock market declined for an extended period, testing investors' nerve and institutional portfolio managers' convictions, and simultaneously, not accidentally but causally, capital rotated into gold and precious metals at scale, not in dribs and drabs, not in the tentative and easily reversed flows of the past 2 years, but in the massive, sustained, conviction-driven rotation that produces the kind of multi-year precious metals bull market that reshapes personal balance sheets. That rotation has not happened yet. That is the news. That is the signal. The stock market's secular bull market, which has produced extraordinary returns for equity investors over the past decade, is approaching the end of its sustainable trajectory. The valuations, the monetary conditions, the fiscal environment, every serious long-term metric points toward a period, perhaps 18 months away, perhaps 12, perhaps 6, when the equity bull gives way to a prolonged decline. And when that transition occurs, not if, but when, the capital that has been parked in equities will need somewhere to go. History tells us, with the authority of a pattern that has repeated itself in every monetary epoch of the modern era, that a very large portion of that capital will go into gold. That is what fuels the projections for gold at $7,000, $8,000, perhaps $9,000 or $10,000 per ounce over the next 3 to 4 years. That is what makes the case for silver recovering past $100 per ounce and moving toward $200. These are not fantasies. They are the arithmetic of capital rotation at scale, applied to a precious metals market that, by the historical standards of prior secular bull markets, is still relatively early in its development. And this brings us to the most important practical question, the one that separates investors who think carefully from those who think superficially. How does one actually capture the extraordinary returns that this analysis implies? The answer is not what most people assume. Stay exactly where you are, because Part 3 answers that question with a precision that no general discussion of gold prices can provide. And one more thing. If this kind of analysis is helping you see the market more clearly than you ever have before, drop a comment below. Tell me what you think. Tell me what you're seeing in your own portfolio and your own research. The conversation in the comments is where the real community of serious investors lives. I read every single one. You've watched this far, which means you already understand something that most investors don't. But what you're about to hear in the next few minutes is the part that almost nobody talks about. The specific, practical decision-making framework that actually turns a correct macro view into exceptional returns. Because being right about gold going to $8,000 means almost nothing if you own the wrong assets. And most people who believe in this bull market are, in fact, positioned incorrectly. Let me show you exactly why. There's an uncomfortable truth embedded in the precious metals investment space that the bull market enthusiasm tends to obscure. Knowing that gold is in a secular bull market does not automatically generate wealth. The index, the GDX, the GDXJ, the ETFs that track the broad basket of mining companies will capture some of the upside, certainly. But the history of prior precious metals bull markets, examined with the same analytical rigor that we have applied to the price charts and the capital rotation data, reveals something important. The companies at the top of the quality spectrum tend to outperform the broad mining index by factors that are not marginal but transformational. And the companies at the bottom of the quality spectrum, the ones that attract capital during bull markets because investors are excited and standards are temporarily suspended, tend to disappoint even when the metal prices are performing exactly as the bulls predicted. The distinction between a well-managed mining company with quality assets, competent leadership, strong balance sheet economics, and genuine operational leverage to higher metal prices versus a company that possesses none of those characteristics, but happens to own ground in a mining district that sounds compelling. That distinction is not merely a matter of degree. It is the difference between a 3 to 5 times return and a total loss, often in the same macro environment, over the same time horizon. This is not speculation. This is the empirical record of every prior precious metals bull market, and it is the record that should discipline every investment decision made in the current cycle. Consider what a legitimately high-quality junior or mid-tier gold producer looks like in the current environment, where gold sits above $4,000 per ounce following its extraordinary multi-year advance. At current metal prices, the best of these companies are generating margins that their counterparts in prior cycles, working with gold at $1,200, $1,500, $1,800, never dreamed possible. The profitability at current levels is extraordinary. The cash flow generation is extraordinary. And the market, in its characteristic short-sightedness, has not yet fully rewarded these companies for what they are actually worth at today's metal prices. The correction in mining equities, which has mirrored and in many cases exceeded the correction in gold itself, has created valuations that, measured against actual earnings power at current margins, represent the kind of opportunity that appears perhaps once per cycle. Now add the forward variable. If the macro analysis we have laid out in the preceding portions of this discussion is correct, if gold does work its way towards $6,000, $7,000, $8,000 per ounce over the next 3 to 4 years, driven by the capital rotation that historically accompanies the transition from equity bull to equity bear, then the earnings power of these high-quality mining companies does not merely increase, it explodes. The operating leverage is not linear. A company that earns, say, $800 per ounce in margin at $4,000 gold earns $1,500 per ounce at $5,000 gold. That is not a 50% increase in earnings. For a company with fixed costs and expanding production, it is far more. The mathematics of leverage in the mining sector, applied to a scenario of rising metal prices over a multi-year period, is one of the most powerful wealth generation mechanisms available to ordinary investors. But, and this caveat is as important as anything else in this analysis, the leverage works brutally in reverse when applied to poor quality assets, over-leveraged balance sheets, or companies whose management teams are better at promoting their story than delivering operational results. The mining sector's history is littered with the remains of companies that had compelling geological stories, exciting jurisdictions, and management teams with impressive credentials, but that failed to translate any of it into shareholder value when the opportunity was greatest. The lesson of prior cycles is not merely that quality outperforms, it is that quality is the only thing that reliably outperforms, and the appearance of quality without the substance is more dangerous than obvious mediocrity, because it attracts capital and then destroys it. The practical framework that emerges from this analysis is not complicated, though it requires discipline to execute consistently. You are looking for companies that demonstrate quality at 3 distinct levels simultaneously. Quality of the asset itself, in terms of grade, scale, and jurisdictional safety. Quality of the people operating the asset, in terms of track record and capital discipline. And quality of the financial structure, in terms of the balance sheet's ability to survive adversity while still funding growth. A company that meets all 3 criteria, purchased at a valuation that reflects current metal prices rather than speculative future ones, has the potential to return 3 to 5 times on invested capital over the next 2 to 3 years at current margins alone. If metal prices move materially higher, as the macro analysis strongly suggests they will, the returns become 7 or 8 times or more. This is the framework that has guided careful precious metals investors through every prior cycle. This is the framework that distinguishes the investors who built genuine wealth during the 2001 to 2011 bull market from those who participated enthusiastically and finished roughly where they started. And this is the framework that is most relevant today, as the multi-month rebound sets up, as the macro conditions align for a sustained advance in precious metals, and as the quality mining companies sit at valuations that the cold arithmetic of earnings power suggests are materially mispriced. The weekly charts for GDX and GDXJ, examined through the lens of the historical correction analogs, tell the same story as the gold price charts. Significant corrections of 40 to 50%, followed by recoveries of 45 to 60% or more, have been the pattern in every prior cycle. We are positioned right now at the point in that pattern where the correction is ending and the recovery is beginning, whether the final low has already been established, or whether one more brief test of support awaits before the rebound takes hold. 25 years of studying these markets does not produce certainty. Nothing produces certainty in markets. What it produces is the ability to read the accumulated evidence, the sentiment data, the technical patterns, the capital flow indicators, the historical analogs, and to form a probabilistic judgment about the direction of least resistance. The evidence, assembled with the honesty it deserves, points in one direction. Precious metals are setting up for a multi-month rally that is likely the beginning of the most powerful advance of this entire bull market cycle. The companies positioned to benefit most dramatically from that advance are the ones built on quality, managed by operators who have proven themselves and purchased at prices that reflect reality rather than fantasy. That is the analysis. That is the framework. That is the 25-year perspective, offered not as a guarantee of any particular outcome, but as the most rigorous and historically grounded assessment of where we are and where we appear to be going. And now, with the discipline that good analysis demands, the last word. Leave your most important question, your most pressing concern, your sharpest objection in the comments below. The real conversation, the one that refines analysis, that challenges assumptions, that makes everyone in this community a more rigorous investor happens there. I will be in the comments. The community will be in the comments. Be there too. And remember, this is for education and discussion only, not personal financial advice.